The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, folks? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic, and for those of you that are new, I'm an experienced hedge fund trader, and this podcast is all about demystifying the world of finance. I'm so glad that you're here, whether you're listening in your dorm room, on your way to class, or just trying to figure out what's next after high school. My goal is to equip you with the knowledge and confidence to build a solid financial foundation and make smarter money decisions. Today, we're going to dive into a topic that's both fascinating and essential, in my opinion: real estate. Big one. I want to introduce you to the world of real estate investing, not as some distant, unattainable goal, but as a tangible, powerful tool for building wealth. So, what we're going to do in this episode, we're going to break down what makes real estate unique as an asset class, explore some of the key terminology, discuss why this is something that you should be thinking about, even if you're still in high school or university. So before we dive in, this is my favorite part. Let's get a quick market update in, go over some bigger items from the last 2 weeks. I know it's been a busy 2 weeks it's been the busiest 2 weeks of the entire quarter, actually, excuse me. So we'll try to keep this tight, but it'll be tough. While I was out, the markets were definitely not taking a break. IPO market continues to be electric. Syndicate desks on Wall Street have been working overtime, it feels like. We've seen some huge names come to market with a lot of fanfare. Just off the top of my head, Fly, we had Figma. Figma, that was Figma IPO, which absolutely exploded out of the gate, and the stock has held up really well since its debut. That was originally going to get bought by Adobe a few years back. Deal got blocked. More recently, we had Firefly Aerospace. Ticker symbol on that one was Fly. This space and defense tech company just had the largest US space tech IPO of the year, raising a massive amount of capital at a price well above its initial range. It's a clear sign that investors are still hungry for growth and are willing to pay up for what they see as the next generation of market leaders, especially in the tech and space exploration space. The reception of these new issues shows a real appetite for high quality companies, even with the broader market's recent jitters. Now, I know nobody wants to talk about it, but we have to. As someone who's a market cynicist a little bit, we have to talk about that little mini sell off that we had Friday, August 1st. Market took a noticeable dip. It was a bit of a reality check after a strong run, I think. We saw some surprisingly weak jobs data come out, which sent a shiver through the markets. S&P 500 was down. Russell 2000, which tracks small cap stocks, got hit particularly hard. It's a reminder that even in the bull market, there are always pockets of uncertainty and macroeconomic data points that can cause a temporary sell off. Honestly, I think it was needed. It was a good day for traders to take profits. And for those on the sidelines, it was a reminder that you always need to be aware of the underlying economic currents. Finally, let's dive into the two big tech stories of the last couple of weeks. Microsoft, obviously ticker MSFT, Meta Platforms, ticker META. Both companies blew out their numbers, meaning absolutely crushed analyst expectations, both top and bottom lines. You'd think their stocks would be soaring right now, just marching higher, but the trading was really interesting, actually. I think in Microsoft, especially on the first day, and Meta in the days following. So Microsoft's report was fantastic with strong growth in its cloud and AI segments. However, the stock got hit the day after the report. Why? Feels like maybe the market seemed to focus on the company's commentary around capital expenditures, or CapEx for short. Microsoft, if you don't know, is pouring billions of dollars into building out its AI infrastructure. And while this is a long term positive, maybe we're not really sure of the ROI on this investment, it means significant spending in the near term. It's truly a fascinating dynamic. The market loves the AI story, but gets nervous about the price tag a little bit, or at least it's starting to, it feels like. It's a classic case of short term cost concerns overshadowing long term growth potential. Truly, only time's going to tell. Now let's jump into Meta. Meta's earnings were also a massive beat. They showed incredible strength in their core advertising business, with AI powered tools driving better ad performance. However, also in the days following the report, the stock was sort of sloppy. I wouldn't say as bad as Microsoft. If you go punch up that Microsoft chart, first day, just boom, drop on the open, never really recovered. Meta had a bid that first day. It failed to move higher on the initial report day and traded in a tight range. There was buyers at that level, but there were also sellers. This is also a bit of a head scratcher. So, like Microsoft, Meta is spending heavily on AI in its Reality Labs division. It seemed that while investors were happy with the core business performance, they're still a bit cautious about the massive and ongoing spending on their long term bets. It sort of highlights the market's current mindset a little bit. It wants growth, but it's also scrutinizing every dollar of investment. And that's just where we are in the tape right now, I think. So there were so many reports, I didn't know what to include. I think next week I'm going to make it a little more focused. But for now, that's it for the market update. It's been a super busy couple of weeks. I've had a lot going on trading. It's clear that there's no shortage of things to keep an eye on in the financial world. So now let's move on and get back into the episode with our discussion on real estate. I'm super excited and I hope you guys are too. So the first big question that I asked when I first started learning about real estate, what makes real estate different from other assets like stocks or bonds? So when you buy a stock, you're buying a small piece of a company. When you buy a bond, you're lending money to a government or a corporation. These are powerful assets and ways to make money, but they're also intangible, meaning you can't really see them. They're just, back in the day, you would get a stock certificate, but that doesn't really happen anymore. Real estate, on the other hand, is a tangible asset. It's physical. You can drive by it, you can touch it, you can see it. This tangibility is a big part of its appeal and its power. So, real estate has been a cornerstone of wealth creation for centuries, and it continues to be a crucial component of a diversified portfolio. One of the most powerful characteristics of real estate is its limited supply. Now, that's super important. Land, especially in desirable locations, is finite. You can't just create more of it. This scarcity is a fundamental driver of its value over the long term. When you own a piece of land, you own something that can't be replicated. Think about a place like Whistler, British Columbia, West Palm Beach in Florida, Malibu down in California. The land here is limited by geographical constraints. Maybe it's overpopulated. These things naturally drive up the value of the properties that are available in these areas. Now, beyond scarcity, real estate offers something called cash flow. So, this is a concept that might be new to some of you, but it's incredibly important, especially as it relates to real estate. So, cash flow is the money you receive from an asset after all expenses are paid. So, in real estate, this typically comes from rent. If you own a property and rent it out to tenants, the rent they pay you minus your mortgage payment, property taxes, insurance, maybe, maintenance costs is your cash flow. So this is a very different dynamic from a stock, which might pay a dividend, but often the primary way you make money is through the increase in its value or appreciation. Now, speaking of appreciation, that's another unique feature of real estate. As the value of your property increases over time, your net worth grows. This appreciation is often driven by inflation, population growth, like I mentioned before, and economic development in the area. This is a crucial distinction from a depreciating asset, something like a car, which loses value the moment you drive it off the lot. Not in all cases. We'll get into that in another episode. There are some cars that actually appreciate in value, but those are rare. Real estate historically has a track record of increasing in value over the long run. Then there's the concept of leverage. This is perhaps the most unique and powerful advantage of real estate investing, and it's a concept that is often overlooked. So, leverage means using borrowed money to increase the potential return of an investment. When you buy a property, you typically don't pay the full price in cash. You put down a down payment, maybe 5%, 20%, and you take out a mortgage for the rest. 5% might be a little low if they're giving you a loan with a down payment of 5%, a little risky. So, with a relatively small amount of money, you can control a much larger asset. Let's say you buy a house for $1 million with a 20% down payment. That's 200,000 that you put down. If that house appreciates by 5% in 1 year, its value is now 1,050,000. You've made a gain of 50 grand on your $200,000 initial investment, which is a 25% return, not a 5% return. Of course, leverage is a double-edged sword. We see this all the time in the stock market where it's abused heavily. It can amplify both gains and losses, but it's a tool that is much more common and accessible in real estate than in other asset classes. Now, for example, if you want to trade on margin or use leverage, you typically have to open a specific account offered by the bank. So now that we've covered the fundamentals, let's dive into some of the terminology. This can be the most intimidating part for a lot of people, but it's actually pretty straightforward. We're going to break it down for you super easily. That's what I'm here for. That's what the podcast is. So, understanding these terms is the key to talking the talk, walking the walk. So, first big distinction you have to understand is between residential real estate and commercial real estate. So, residential real estate is what you think of when you hear a home. This includes single family homes, which are exactly what they sound like, a house for one family. It also includes multifamily properties. These can range from a duplex, which is a building with two separate living units, all the way up to large apartment buildings with hundreds of units. This is a great starting point for a lot of investors because you can live in one unit, rent out the other, which can help cover your mortgage. So, this is a strategy known as house hacking, and it's a brilliant way for young people to get into the market. Commercial real estate is anything that it isn't residential. It's used for business activities. This category is massive. You've got retail real estate, which is where stores, restaurants, shopping centers are located. Next time you're walking through the village in Whistler, look at all the storefronts. These are all retail properties. Then you have office real estate, which is where businesses conduct their operations. Think of all the office buildings in downtown Toronto. Another big one is industrial real estate. Industrial real estate, which includes warehouses, factories, and distribution centers. So, interestingly enough, with the rise of e commerce, industrial real estate has become a really hot sector. Finally, there's special purpose real estate, which includes things like hospitals, schools, and theaters. Understanding these different types of real estate is crucial because they each have their own risk and return profiles. Residential real estate is often seen as more stable, while commercial real estate can have higher returns, but also higher risks and more complex management. So, why should you, as a high school or university student, care about any of this? Because it's never too early to start thinking about your future and building wealth. And when it comes to real estate, you don't have to be a multimillionaire to start. The first step is to simply understand the concepts because there's a lot of them. And investing in every subclass of real estate, it's important to understand. Maybe you're not ready to buy a house, and that's okay, but you are likely renting. Understanding the real estate market can help you make a more informed decision about where you'll live and what you end up paying in rent. Hopefully, after this discussion, you can start to see things from maybe a landlord's perspective and understand the factors that drive rent prices. This knowledge is going to give you a little bit of an edge in the marketplace. But what if you're not ready, or maybe you don't want to be a landlord? Maybe you're not ready for the responsibility of property ownership. The good news is that you can still invest in real estate. So there's a very interesting product called a REIT. This is a real estate investment trust. A REIT is a company that owns, operates, or finances income producing real estate, and they trade on stock markets. Think of it like a mutual fund for real estate or an ETF for real estate, maybe. You can buy shares of a REIT on the stock market, and it gives you exposure to the real estate market without having to buy a physical property. You can invest in a REIT that owns apartment buildings, or maybe a REIT that owns shopping malls, or even one that specializes maybe in hospitals or casinos. There are so many different ones. Industrial warehouses. There's now some for data centers as well. This is a great way to start because you can invest with a small amount of money and you can get a professional team to manage the properties for you. This is also a way to gain exposure to different types of real estate, like commercial properties that might be too expensive to buy on your own. Now, let's add a new layer to this conversation and talk about some more advanced but still accessible strategies and also how to navigate the financial side of things. This is where you really start to put the pieces together. So let's start with an investment strategy called real estate crowdfunding. This is a newer concept that has become really popular. It's essentially like a Kickstarter for real estate. Instead of you buying a whole property, you and a large group of other investors pool your money together to invest in a specific project. This could be a new apartment building be developed, or maybe it's a commercial property, maybe it's a mall. So, what this does is this allows you to invest in projects that would be far too expensive for a single person to take on. The returns are generally tied to the success of the project. It's an interesting way to get exposure to large scale real estate without having to manage it yourself. You can get started with a much smaller amount of money than it would typically take to buy a physical property, especially for commercial real estate. Now, another strategy you might hear about is house flipping. And this was really popular in Vancouver when I was growing up. This is where you buy a property that needs a lot of work, fix it up, and then sell it for a profit, all within a relatively short period of time. This can be very, very lucrative. It's very popular. It's been going on for a long time, but it's also one of the riskiest strategies. It requires a deep understanding of construction, an accurate estimate of renovation costs, labor costs, and a good sense of the local market. For a beginner, the costs can quickly spiral out of control and you could end up losing money and you could end up losing a lot of it. My advice here is to proceed with extreme caution and really only consider it after you've built up some experience and some capital. It's not something you should jump into as your very first real estate endeavor. A more collaborative approach is forming a real estate partnership. This is when you, a few trusted friends or family members, pool your resources to buy a property together. This can allow you to buy a larger, maybe more expensive property that you could on your own. This allows you to buy a larger, more expensive property that than you could on your own. It's also a great way to share the responsibilities and the risks. The key here is to have a very clear, legally binding agreement in place from the start that outlines each person's responsibilities, their share of the investment, and what exactly would happen if someone wants to exit the partnership. This is a great way to break into the system with your social network or maybe family members, and it can be a powerful tool for young investors. So, finally, let's talk about the practical steps you can take today to prepare for real estate investing in the future. So, maybe the single most important thing that you can do is to build a strong credit score. I talked about this in the credit episode. Credit score is key. Your credit score is a number that represents your credit worthiness to lenders. You would know that if you watched the episode on credit. The higher your score, the better interest rate you'll get on a mortgage. A good credit score can save you tens of thousands of dollars over the life of a loan, especially when you think about a mortgage that lasts for as many years as it does at those amounts. It can save you a lot of money if you have a good credit score. So, how do you build a good credit score? You should go watch the episode from Trajecta Talks regarding credit. But I'll give you a quick blurb here. It starts with responsible credit card use. Get a credit card, use it for small purchases, pay off the full balance every month, don't carry a balance, always pay your bills on time. This is a habit you should start building in high school or university. And again, go visit the episode on credit. We go through it in much more detail. All right, so now let's shift gears and talk about why real estate isn't just an important asset class, but arguably the most important for the average person, especially when it comes to building generational wealth for the middle class. So, historically, and even today, the primary way that many middle class families build significant wealth is through the appreciation of their home values. So, think about it this way. For most people, their home is the largest asset they will ever own in their lives. Unlike a car that depreciates or even a stock portfolio that can be volatile, A well located piece of real estate tends to appreciate over the long term. This isn't just a nice bonus, it's a fundamental driver of financial security and upward mobility. So let's break down why this appreciation is so crucial for wealth creation. So, first, there's the concept of forced savings. When you pay your mortgage each month, a portion of that payment goes towards paying down the principal of your loan. So this means that with every payment, you're building more equity in your home. It's like a savings account that you're legally obligated to contribute to, and it's backed by a tangible asset. Many people struggle with consistent saving, but a mortgage provides that discipline. You can't just stop paying your mortgage. I mean, you can, but you will default and then you'll lose your home. Over 20 or 30 years, that forced savings accumulates into a substantial amount of equity in your home. Secondly, we have inflation. We've talked about it briefly, but let's dive deeper. Inflation is the general increase in prices and fall in the purchasing value of money. When inflation occurs, the cost of goods and services rises, and so does the cost of building new homes. This drives up the value of existing homes. Your mortgage payment, however, is typically fixed unless you have a variable or adjustable rate mortgage. So, as your income and the value of your home increase with inflation, your housing cost remains relatively stable, making your home more affordable over time and increasing your real wealth. It's a powerful hedge against inflation. Now, I want to put an asterisk there. That is only true if you have a fixed rate. With a variable rate, when rates go up, so will your mortgage payments. So, third, there's population growth and demand. As populations grow, especially in desirable urban and suburban areas, the demand for housing naturally increases. More people needing places to live means more competition for available properties, which pushes prices up. That's the natural law of supply and demand. Uh, Even in areas with slower population growth, economic development, new jobs, and improved infrastructure can attract people and increase demand. So think about Silicon Valley, for example. New tech companies opening large offices, that brings new jobs, new residents, increased demand for housing, leading to appreciation in that area. And that's why you saw appreciation in that area. And that's why you're starting to see a similar thing in Texas as more tech companies move there. Fourth, the limited supply of land is a constant factor. As we discussed, you can't just print more land. Zoning laws, environmental regulations, geographical constraints like being surrounded by mountains or water, as we see in British Columbia. All of these things limit the amount of developable land. Tough word to say. This inherent scarcity ensures that land and the structures built upon it retain and often increase their value over time. So, what does this all mean for you, the 18 to 27-year-olds listening right now who are looking at a real estate market with historically very high prices and in many places high interest rates? It's easy to feel discouraged, to feel like you've been priced out before you even had a chance to get in. And I get it. I'm in that position too. It's a tough market, but here's the crucial takeaway. The principles of real estate wealth creation haven't changed. The path might be harder, but it's still there. The biggest mistake that you can make is to do nothing. So while prices are high now, real estate is a long-term game. I'm not suggesting you go out and pay these prices at the top of the market. There might be a lull. I don't know. I'm not a speculator in the real estate market. But the goal isn't to time the market perfectly all the time. Sometimes you just need a home. It's that time. Over decades, the ups and the downs, they might smooth out, and the overall trend has historically been upward. Now, again, as I said in the beginning, this isn't investment advice, but that's just what I've noticed historically. And so maybe you want to wait for the next little pullback, and that might be your chance. So, what are some actionable strategies for you to navigate this challenging market? Aggressive saving, financial discipline. This is a non-negotiable. The larger your down payment, the less you need to borrow, and the more affordable your mortgage will be. So start saving now, even if it's just a small amount, a few $100 a month. Every dollar that you save today is a dollar that can grow and work for you. You might even want to consider automating your savings, set up a direct transfer from your checking account to a dedicated savings or your TFSA, FHSA every payday. And make sure you're mastering your credit score. That's another big one. I can't stress that one enough. In a high priced competitive market, lenders are looking for the most qualified borrowers. A strong credit score translates directly into lower interest rates, which can save you tens of thousands of dollars over the life of a mortgage. Get a credit card, use it responsibly, pay it off in full every month. Monitor your credit report regularly. Make sure there's no mistakes, there's nobody trying to steal your information. Another thing you want to consider is geographic flexibility. So, you might not be able to afford a detached home in downtown Vancouver or Toronto right out of university. I don't know anybody that can. And that's okay. Broaden your search. Look at smaller towns, emerging communities, or even different provinces where housing is more affordable. I know a lot of folks that left BC to go live in Saskatchewan and Alberta. Remote work opportunities are making this more feasible than ever before. So, if you're ever going to do it, now would be the time potentially. A property in a more affordable market can still appreciate and build wealth, and it can be a stepping stone to maybe your dream location later on in life. I also encourage you to explore first time homebuyer programs. So many governments, including the Canadian federal government and various provincial programs, offer incentives for first time home buyers. So these can include down payment assistance, there's a bunch of tax credits, or reduced mortgage insurance premiums. Do your research and see what programs you might actually qualify for. These can significantly lower the barrier to entry. There's also an FHSA, which is the First Home Savings Account, where all of your gains are actually not taxable, just similar to a TFSA. Invest in real estate indirectly through REITs. That's another thing we talked about earlier. If direct ownership isn't feasible right now, or you want to diversify, remember the REITs, REIT. These allow you to participate in the real estate market, earn dividends, and benefit from appreciation without the responsibilities of being a landlord. This is an excellent way to start building your real estate knowledge and portfolio while you save for a direct purchase later on in life. So, the current real estate market might feel daunting. I totally get that. I, at times, some days feel that way. But remember that every generation faces its own unique challenges. The key is to adapt, learn, apply smart strategies. Real estate remains a cornerstone of wealth creation, and with the right approach, it can absolutely be a part of your financial future, regardless of your age or the current market conditions. Now, as we wrap up the scheduled content portion of this episode, we have to get through this week's stock picks. I was on a business trip for 2 weeks and we did have a couple submissions. I was so excited to see that. Let's get right into it. So, first up, we have a submission from James. James, who sent in a short sell idea for Microsoft, ticker I said earlier, MSFT. Now, James, you've got some serious guts submitting this on the morning after their earnings report. He specifically telling us to short the stock on market open at a price of around 556 is, I think, to the minute when he sent it. Well, as of this recording, Microsoft is trading around $521. As we talked about earlier, the earnings report stock definitely traded down. James, that's an absolutely fantastic call. You've successfully navigated the post earnings volatility and made a great profit on that short position. So, next up, we have a submission from Jorge, who wanted to go long on advanced micro devices. That's ticker AMD right before the earnings report. Jorge submitted his pick to us on August 4th at a price of $177.30. Unfortunately, the day after the report, the stock sold off. Now, as of this recording, the stock has since rebounded and is trading around 172.40. Still a bit below your entry, Jorge. Maybe better luck next time. Good idea. I like the thinking there. AMD's report, unlike Microsoft's, was met with a bit of a shakeup. The company posted some impressive numbers, no doubt. There was strong revenue growth in their data center and client segments, and their CEO, Lisa Su, even made some very, very bullish comments about their AI ambitions. AMD is making major strides in the AI GPU space, and analysts are raising their price targets. However, the market reaction was definitely muted and the stock actually sold off. This could be due to a few factors. Some investors might have had even higher expectations given the recent run up in the stock price, which saw AMD rally over 30% in July. The buy the rumors, sell the news phenomenon is a real thing. We've talked about that in the past. It's a classic example of how sometimes a good report isn't good enough if expectations are sky high. So while the initial reaction was a bit disappointing, underlying business at AMD seems to be firing on all cylinders and just fine. They're gaining market share against their rival and have a very promising AI roadmap. Jorge, don't lose faith just yet. This is a long game and the fundamentals of the company still look strong. I'll leave it up to you to put your stop in and decide when it's time to kick that loser. I'm not sure that it's now. Maybe it is. You'll let us know in the comments, hopefully. Thanks for the submission, and we'll keep an eye on it for you. Folks, thank you so much. That's all the time we have for today. Thanks for joining me on Trajecta Talks. I hope you found this introduction to real estate to be insightful and empowering. Remember, the journey to financial freedom begins with a single step, and that step is knowledge. I honestly, truly believe that. To stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, and Facebook by clicking the various links that I have posted down below in the show notes. Also, please check out our YouTube channel if you prefer to watch your podcasts. All the links are in the show notes down below for you guys. So until next week, keep learning, keep investing in yourself, keep building your future. Thanks so much for being here with me today, folks. I hope you have a very happy Friday. Take care.